Hey guys, welcome to another Monday Market Update Chat with Steffani and Rozella over in Spokane or Deer Park, Eastern Washington. They know the state well, I assure you. And today we were chatting off camera. We're going to chat about some fun things. I love it when we talk about lending parameters, so we're going to do that. Do you have any questions you want to start out with, ladies, or shall we just start with the stuff we were talking about, low down payment options? Where would you like to go?
We were talking about parameters that you as a lender will typically follow for different loan types, such as conventional, FHA, VA, so that when you're looking at a home and writing a pre-approval letter for that offer, you can look up the home and say like, okay, this is some things I'm seeing on the home for lending purposes. These things might not work. So what are some typical things that you know and see or different styles of homes
that we can utilize to prep our buyers?
Yes,
Yeah.
for buyers specifically.
So we'll focus on first-time home buyers for at least the first part of the conversation, and we might have to do another video to talk about investor loans or something later on.
Okay.
There are low down payment options in all of the groups that we've talked about. So there's conventional, and then there are government loans, and government includes FHA, VA, USDA, and I guess that's about it. In the conventional world, the lowest down payment is 3% down, and it typically is for a first-time home buyer. A first-time home buyer is someone who has not owned a home in the last 3 years. So if you owned a home 4 years ago and you sold it and you haven't bought a home for that time, you're considered a first-time home buyer again, and you qualify for that kind of program. So that's cool. And while I'm there, we have a community home plan. I got to get the right name for this. It's a special program that allows for people who purchase owner occupied only lower rates if you buy in an area in particular that a bank needs to lend in. So this gets really fairly complicated, but let's simplify it. The larger lenders that we work with, so Bay Equity is a mid-sized lender, and we sell our loans to larger entities like Chase and Bank of America, the big dogs, right? Those entities are monitored by the federal government, and they look at where they lend and they look at their types of loans they do, and they might step in and say, you aren't doing enough loans for this particular area, so you need to do more loans over there for that kind of client that wants to live there. And in order to do that, the big dog will offer incentive pricing, which means lower interest rate. Potentially, and low down payment options. And we have direct access to that because we sell to those lenders. So that's a great program to be aware of. It's specific to particular areas, and we can talk about that in a whole nother video. I can get the areas for you if you want, with noticeably lower rates and low down payment options like 3%, 5%. So that's the community lending standards stuff that we're talking about there. In addition to that, even if it's not in that particular area, we still have the 3% down program. And let's compare that with the government loans. So the other government loan that people know really well is FHA, which is 3.5% down. So it's really close. And from a lending perspective, there's some advantages and disadvantages to each. And as you were saying, Rozella, one of the disadvantages of FHA is we're a little picky on the appraisal. And the FHA appraiser is going to do a little bit more inspection. They stick their head in the attic and look around up there with their flashlight looking for insulation and all of that. They also look in the crawl space if there is one for the house. And they look at things that a regular conventional appraiser may not look at. And they're a little more picky about things. And as you learned on your manufactured home that you're talking about, they can be a little more picky on manufactured homes as well. And if they need something done, then you have to do it. We don't know that as a lender typically until I get the appraisal. What I'll do is I'll go online, I'll look at the house, and I'll talk to the real estate agent and say, is there anything on this house that you're a little concerned about that we might have some problems with lending, either conventional or FHA? And then if they point that out, then we kind of want to deal with it up front before we get the appraiser out there. Typically, that's the goal, right? But if the appraiser comes back and says, well, you have a problem here, the appraiser is our eyes on the home. We don't require an inspection. Now, you as good real estate agents, I know you have inspections done for most of your clients, and we typically never even see that report because we don't want to, because it probably tells us things more than we want to know. But the appraiser's our eyes, so they're going to look at it, and if something obvious, they're not really looking for problems, as you know. They're looking for value. But if they see a hole in the roof, they're going to certainly tell us about it, and that needs to be dealt with, right? Or cracked windows, panes, stuff like that. So property characteristics, government loans are typically more picky than conventional loans. So if you have a home that you're just a little concerned about, and a lot of agents I know are, because they say no FHA on this property, and I'm sure I know where they're coming from, then we'll do conventional if we can over FHA or even VA or USDA. VA and USDA typically follow HUD guidelines. HUD is FHA, so they're also kind of picky. So I'll pause there for a moment. Any questions or comments on that?
Yes, go for it. So, if we know that somebody's an FHA buyer and we know that they are looking at manufactured homes in particular, we know, or at least I know from prior lending experience as well, there's certain little fun items that I typically always prep my clients for, that I'm like, hey, by the way, just know this particular home has a deck attached to it, or this has an awning attached to it. Can you please explain to us why and what the additional appraisal requirements will typically be when we see properties like that?
Certainly. Things that are decks and it's decks and porches typically, and awnings, you're absolutely right, cannot be attached to the manufactured home because the structural integrity of the home may be compromised if somebody starts drilling holes in the frame and attaching things to it. So the appraiser is going to look and make sure that they're not attached. That means that that deck needs to be self-supporting and not attached to the manufactured home. And I've had more than one where they had to go out and fix the deck so that it's self-supporting and not attached to the manufactured home. And then in addition to that, as we were talking some time back, there's tie downs for the foundation on the manufactured home. And if it's FHA, we require that we do another inspection, usually I think by an engineer. Ladies, you might know better than I on that, to make sure that the tie downs are good and up to FHA guidelines.
Yeah, so we have a engineering certification that's typically required.
Yes.
Or structural engineer, structural, something like that. And then your traditional appraisal, and then how often does L&I have to come out then to also support that structural engineering certification?
I don't think L&I has to come out and support it from my understanding, but if there's something that isn't right and then it needs to be fixed, then L&I gets involved because they want to come out and inspect it. And it can be a pain and it can take a long time.
Correct. Apparently in our state, it's been a while. Another one is, especially for our area, because we have such old homes here, we had knob and tube electrical in a lot of our homes, and we started running into this for like FHA new like home buyers. Are you using that? And then that's one of those things that you can't really see right away. Like you're not gonna be able to see like, oh, a deck is attached. You can notice that, where it's like knob and tube, you'll get that back in inspection sort of thing. And so that's another issue that comes up a lot in our area.
That's probably one of the things that the appraiser's looking for when they stick their head up in the attic to see what kind of wiring there is. I haven't seen knob and tube in a long time, but we used to have to deal with it.
Come on over. These homes over here, it's so common. You still see it. And you want to know how many homes are still running off of just knob and tube?
I don't doubt it over there. Yeah.
Crazy. Yeah. All right. So for conventional, then, what's something that underwriting may flag and call back that you've had for like things realtors could be looking for or buyers should be looking for in the home?
All right. There's probably two areas for all loans, including conventional, that we're going to look at. One of them is code and safety violations or issues. So if you see a deck in the rear that's got some wood rot and you're going to step through and hurt yourself, or the railing isn't up to code or something like that, that's certainly going to be a problem. So anything you say, oh, there's a tripping hazard there, or that, I wonder if that doesn't meet code anymore, that deck that is 3 feet up in the air that doesn't have a rail and stuff like that, right? That kind of stuff will need to be fixed. And then the other thing is going to be, in that category, by the way, might be cracked window glass and things of that nature. If we see that kind of stuff, those are safety hazards and they'll need to be dealt with. In that category, it could even be an outbuilding that the person hasn't used in years, and it's kind of a safety hazard if somebody's crawling through there, that could end up being a problem if an appraiser calls it out. Again, the appraiser is going to be our eyes, and if they say, "Oh my goodness, that building's kind of leaning over, could fall any minute on somebody," we're going to have a problem with that, right? I don't normally see that, but that's kind of an extreme example for you. The other area is going to be the condition of the home, and in particular, anything that would cause degradation over time or the kitchen, such as peeling paint on the exterior of the home. Any appraiser that points that out to us, and FHA appraisers are more particular, I think, on that than conventional. I don't know if that's totally true, but that's my perception anyway. If there's peeling paint, if there's bare wood, if there's anything the house is going to potentially degrade over time, that's going to have to be addressed as well.
So conventional is a little bit more lenient, obviously, with their appraisal. Not that it's in a being a picky. I think it's more so just for the security of the buyer, of assuring that whatever it is that they're purchasing does not have some sort of latent defect that's going to come up and be a costly, item.
I mean, conventional is going to, if it's an obvious thing, guys, bare wood on the outside of a house and trees touching or dirt touching the exterior of a home where there's wood, and you can get wood rot over time, that's going to get flagged by any appraiser. Stuff like that we're going to see, and it needs to be dealt with.
Okay. Yep. Is there, I'm switching gears now,
Go for it.
from off of appraisals.
All right, let's do it.
To a buyer, is there more of an incentive for someone to go FHA versus conventional? Because oftentimes, especially first-time home buyers, or those first-time, I'm going to do the air quote, because you can be a first-time home buyer after 4 years.
More than one. You can do that more than one.
Is there really truly any incentive for them or free money that they have available to them? Because a lot of people somehow, some way get that idea in their head. So debrief that or confirm that for us, please.
That is a great question that you asked, Stephanie. Yes, there are incentives, and a couple of different ones. So Washington State and different municipalities within Washington State and different states that we deal in, but we're kind of focused on Washington State in this conversation, have no down payment options available. In Washington State, it's fondly called by most realtors the Washington State Bond Program. So Washington State residents, they buy bonds with Washington State Housing and Finance Commission. I'm a little off on that because it's been a while since I looked at it. It's a long name that creates a bond. They get a bond for putting their funds in there, and those funds are lent to, it's not a gift typically, it can be. Normally it's not a gift, it's a second mortgage which is given to homeowners to use as the down payment option for FHA and conventional and closing costs. Typically it's 4%, it's a weird number. It's typically 4% of the loan amount rather than the purchase price, which is enough to cover 3.5% of the purchase price, typically right in there. And there are different degrees of that, and it's a little more complicated than just that. But basically, the homeowner can get a grant in some cases. More often than not, it's a loan, and I don't think it has much of an interest rate at all, and there are no payments required on it that they use for the down payment, because that's the biggest limitation most people have, is they can't build up. I mean, even a 3% down payment on a $400,000 house is $12,000. That's a fair amount of money. So this will help them do that. So they get it helps capture that down payment for people so they can move forward with either FHA or conventional. So that's kind of the same. The advantage FHA has is this. If you have a credit score below 700, you're going to find in the conventional world that the interest rate is reflectively higher than it would be unless you had that 740 credit score, and the mortgage insurance cost is higher as well. So backing up one step, if you put less than 20% down on a home, you're going to get something called mortgage insurance. That's not your homeowner's insurance policy. You're going to get that no matter what to insure the home. Mortgage insurance insures the mortgage for the lender, but you, the buyer, get the pleasure of paying for that. And it costs different things for different people in different situations for mortgage insurance. So the lower down payments, like 3% down and 3.5% down with FHA, have a higher mortgage insurance cost than if you put 10% down, goes down quite a bit. Put 15% down, it goes down a lot, but it's still there until you put 20% down, then it goes away. Now, the exception to that, because there's always one, of course, is FHA. No matter what you put down with an FHA loan, you're going to have mortgage insurance to pay with FHA. If you put a low down payment, I believe it's less than 10% down, the mortgage insurance is going to be there forever until you refinance or sell the home. But if you put 10% or greater down, it's there for a mere 11 years, and then it finally goes away. Whereas in the conventional world, your mortgage insurance is dictated more by the loan to value. So when you get enough equity in your home, and there's a couple calculations there, but basically if you get 20% equity, you can typically remove mortgage insurance in the conventional world. Now, why would you go with FHA if it's there forever? It's because FHA is very nice to low credit score borrowers. We do FHA loans with borrowers with credit scores in the 500s, believe it or not. Conventional won't even do that loan. If you're down in the mid 600s, 620, 630, 640, FHA rates are way better than conventional rates because they don't hit you nearly as hard. And FHA was kind enough about I bet it's been a year and a half now, to have lowered the FHA mortgage insurance premium. So it's very competitive now with conventional, especially if you have a lower credit score. It's better. It's less expensive if your score is in the mid 600s than conventional by far. And the rate with conventional is higher. So in a nutshell, if you have a score that is below 670, 680, 660, somewhere in there, FHA is probably a cheaper loan for you to do than conventional.
Okay. So
Okay.
just to recap, FHA has a mortgage insurance premium that does not matter or care how much money you put down. That mortgage insurance premium is always going to remain with that loan until you refinance out of it.
If you put 10% down or more, it's there for 11 years and then it goes away. If you put less than 10% down, it's there forever.
What do you have to do to make it away?
One other thing on FHA, just while I'm here, there's an upfront mortgage insurance premium that FHA has as well, which is currently 1.75% of the loan amount. So
Okay.
that's a one-time premium. And what we do typically there is we finance it into the loan for them. You can do the same thing in the conventional world, but there's more options. You can, in conventional, let's just keep it simple for that. And then FHA has the monthly mortgage insurance premium as well, which is what they lowered. So it really helped with the payment.
Okay.
You're stuck with it, but you get cheaper upfront, less down payment.
Well, I think that FHA must have done something to improve over the years because FHA used to never let it drop off where it can now. So,
Well, if you put the 3.5% down, Stephanie, which most people do, it's there for the life of the loan, right?
right. But if you can come up with 10%, then
Yeah,
it drops.
that's right.
Mhm.
Which most people don't do, but some do. I have people put 20% down and do FHA because the rate is so much better than conventional with their 601 credit score. That's why they do it.
Credit scores, but so a big deciding factor is credit score is where people are deciding whether they want to do FHA or conventional.
Yeah, and that's true of VA too, USDA to a point as well. So let's talk about government loans for just a little bit here. So you have FHA, VA, and USDA. FHA is for anybody who wants a loan and qualifies for that loan. There are really no stipulations for area or anything like that, other than you just got to qualify for the FHA loan. VA is for a veteran or active military, or the spouse of a veteran or active military person can get a VA loan. And what's wonderful about VA is it's zero down. It is possibly, arguably, depends on who you talk to, the best zero down program there is, because VA has a one-time mortgage insurance. It's called the VA funding fee in the VA world. It's called the mortgage upfront mortgage in FHA world that they pay, and there's no monthly mortgage insurance with VA, which makes it really, really nice. And VA has two other advantages. Their rates are really competitive. They're in the FHA range for rates, which is typically better than conventional. And here's what I love about VA. Their debt to income ratio is higher potentially than any other loan I know of. What happens is we're going to take any loan we do these days, almost, is going to run through an automated underwriting system. And the automated system is really, really smarter than we are and better than we are. It's got a lot of data in there that it's been tracking for years, which will give us a yes, a no, or a maybe. And if it gives us a yes, this person is qualified, then the underwriter, all they're going to do is they're going to ask for the conditions that the automated underwriting systems request, which is like a pay stub and a W-2 and verification of down payment stuff. If it says no, then you're not going to get the loan. If it says maybe, then it reverts to what we call a manual underwrite, and then it gets really picky and it's hard to do because manual underwrites are just more picky. Yeah. But VA will allow debt ratios in the 60s. I don't know of any other loan that will do that. It's amazing. So a VA borrower with good credit and with good reserves may be able to buy a home that no other borrower would be able to buy with a 0 down payment because it'll let the debt to income ratio be so high. And that's all depending on what the automated underwriter says. Go ahead.
Fun fact about VA. VA is one of, if not the only type of financed loan that you can get for a manufactured home that's been moved more than twice, that it'll still lend on it.
That is a good fact with VA. You're absolutely correct. VA will do older manufactured homes at times, but you have to do the L&I inspection and all that kind of stuff to make it. USDA is a beautiful program. Love it to death. It is 0 down, which provides 100% financing. It has 2 very restrictive, well, 3 really, very restrictive criteria, okay? One is it only lends in areas that are USDA acceptable. Those are considered rural by nature. They may not be rural where you think anymore because they don't look rural to you anymore, but USDA may still consider them rural. So you're not going to do a USDA loan in the middle of Spokane, but you could conceivably do one up in Deer Park because it's considered rural still. You can't make too much money with the USDA loan. There's an income cap for the household, and it's kind of complex, but basically we take a look at the number of people in the household and how much money the whole household generates, not just the people on the loan. And if you make too much money, you can't do USDA. And then the other thing is they're very conservative in their debt to income ratio, unlike VA. The front ratio, which is the housing expense, just the housing payment divided by the income, can typically not be greater than 29% with USDA. FHA will let it go to 47 almost always in FHA. So it's way different, but it's a great program for those that qualify.
So out on the outskirts, don't make too much money, but also don't be having too much debt and you might qualify.
That's exactly right.
Okay.
You're gonna be right in the middle.
Good to know. I think that probably covers most of our topics and kind of like the main questions that we typically get around all of those financing types. So thank you for answering those questions for us.
Absolutely. We'll have to do another one on investor loans. We've kind of covered some investor loans, but we should just do one that kind of covers them all together sometime. It'd be kind of fun.
Awesome.
For sure.
Thank you, John.
Thank you, Rozella. Thank you, Steffani. Always a pleasure to chat with you two.
Thank you.
Chat with you.
Always very insightful and full of information. So thanks.
Yes, we are. We're full of lots of information. Give the ladies a call if you have any questions. If you're on our YouTube channel and we're watching this, subscribe, give us a comment, reach out. We're happy to help you with any questions you might have. Thanks, ladies. Nice to talk to you today.
Thanks. Bye.
Bye-bye.